Does neoliberalism lead to financial instability? Imagine a world where markets are free to do whatever they want with less government oversight. That's what neoliberalism promotes: less regulation, more financial freedom. But does this approach make the economy more stable or more prone to crashes? That's what many experts are debating today. Neoliberal policies push for deregulation of financial markets and encourage banks and investors to take bigger risks. They also promote financial liberalization, making it easier to move money across borders and invest in complex financial products. While this can boost economic growth in the short term, it also opens the door to dangerous speculation. For example, during the late 1990s and early 2000s, risky lending practices increased. Banks gave loans to people with poor credit, leading to the subprime mortgage crisis in 2007 and 2008. When these risky loans defaulted, it caused a chain reaction that led to a global financial collapse. This crisis showed how deregulation and risky financial behavior can create instability. Neoliberalism also shifts the focus from stable, productive investments to speculative activities. Financial markets become more about betting on asset prices than supporting real businesses. This often inflates asset bubbles, like real estate or stock market booms, which eventually burst and cause economic downturns. When asset prices fall sharply, it affects millions of people who lose savings, jobs, or homes. Another point to consider is how neoliberalism weakens the link between wages and productivity. Instead of sharing profits with workers, companies often relying on debt and rising asset prices to grow. This makes the economy more dependent on credit and increases the risk of financial crises if debt levels get too high or if asset prices fall. From a socialist view, these issues show how the system prioritizes profits over social stability. They argue that only a planned economy with public oversight can prevent these boom and bust cycles. By controlling investment and ensuring wages grow with productivity, they believe the economy can be more stable and fair. In the end, the connection between neoliberalism and financial instability is clear. While it can lead to short-term growth, it also increases the chances of economic crashes. Many believe stronger regulation and public control are needed to keep the economy steady and protect ordinary people from the risks of unfettered markets.